Welcome to the JD Power Insurance Intelligence Podcast. I'm Michael Vermillion with JD Power, and with me today are Steve Crewdson from the insurance practice. Welcome, Steve. Breanne Armstrong, also from the JD Power Insurance practice. Welcome, Breanne. Thanks for joining us today.
Thank you.
And we have a special guest, Jim Vecchio from JD Power's Autodata Solutions practice. Jim, welcome, and thanks for joining.
Thanks, Mike.
So the topic for today is how can the auto insurance industry price insurance policies more accurately? How can the industry improve pricing accuracy? So Steve, why don't we kick it off with you on this topic of pricing accuracy? Why does it matter? What does it matter to have more accurate pricing and more accurate information for more accurate pricing?
Yeah, great question. It's one of the most important questions in the industry. So insurers really endeavor to have the most accurate pricing they can for the policies that they're selling. We're all familiar with the idea of underpricing and what could lead to adverse selection there. So if we're underpricing a lot of risks, we'll have a lot of those customers come to us as an insurance company. And then as the claims start to roll in, we'll find that we're not reserved well enough. We didn't have enough capital. We didn't have enough premium that we're collecting to pay for all those claims because we were systemically underpricing those. If we're overpricing, the risk, of course, is we don't win new business. We don't grow because every insurer has some amount of business leave every year. And if we're not bringing in new customers through accurate pricing, we will shrink as a company. So insurers really focus on not being too high priced and not being too low priced. There's risks either way. And over the last couple of years, the price has really been the leading story in our industry. You think about the effects of economic inflation driving up every cost that we're paying across the industry in terms of claims costs. And then economic inflation doing that, and then social inflation hitting on the liability side of claims. All the things around third-party litigation funding, the fact that more claims are being litigated. When they're litigated more, we're seeing more and more that there's larger settlements, larger judgments being laid down on these claims. So the costs to insurers are going up, and consumers have seen their costs go up in their premiums because of all the costs that are going up due to economic and social inflation. So what consumers have done is responded by going out and shopping. We've seen some pretty volatile shopping numbers over the last 2 years in our list product. And most recently in Q1, we set a new record for shopping, consumers shopping for auto insurance in the first quarter of this year. And that ended up getting smashed in Q2, an all-time record in Q2 for shopping for auto insurance. So when you ask consumers, why are you shopping? You're seeing more and more they're saying because of price concerns, because I've seen a 20% or more increase in my premium and I need to go find a lower premium. So as an industry, obviously we've already talked about the risks of being too high or too low priced, the inflationary effects driving consumers to market. And I think I'd close with some insurers have really spent decades becoming more sophisticated here. You think about insurers like, I'll use Progressive as an example, that is really sophisticated in their pricing. They were out early increasing premiums in this hard market. They kind of were the canary in the coal mine, so to speak, that the market was about to get really hard and prices were going to go up because they were taking rate early. That allowed them to stay in market, winning new customers when others were pulling back because they were not rate adequate. Those other competitors that were not rate adequate pulled back from acquiring new customers. And Progressive, as always, has been able to write some risks that others won't because they're confident they're pricing that risk accurately. So really, again, speaking to those in the industry, it's no breaking news, but price accuracy is really the name of the game in our space. And to the degree to which you can have better data to increase your price accuracy on the auto physical damage side of things or on the liability side of things, insurers want to get their hands on that data and start to use it to improve their pricing accuracy.
Thanks, Steve. Breanne, why don't we go to you for a servicing angle here? So how can price accuracy put carriers in a better place when it comes to servicing?
Yeah, that's a great question, Mike. So, with the rate increases being what they are now, we've noticed that customers are more sensitive to the servicing in general. So we used to see servicing would influence wouldn't switch at any price a lot more. So that's kind of one of our metrics we look at is how likely are customers to switch, or not switch regarding, the price that they're paying. And so now we're seeing that kind of more customers are falling out of that bucket, right? They're willing to switch. It might be for a bigger savings, right? They might say, okay, well, before I wouldn't switch at any price, but now, okay, maybe if I can save X number of dollars, then I would consider it. And so, in thinking about having the pricing right for the policy in the first place, that's going to put insurers at a better position. So maybe they don't have to raise rates as kind of a blanket way that they've essentially had to almost in order to get closer to rate adequacy. If the pricing's right from the start, then maybe it won't impact as many customers to the same extent, especially those who, maybe are a little bit more high value customers, right? Those are the ones that are less risky. If we're not pricing their policies right and, now they're having to take rate increases, those customers are especially sensitive, right, to having the rate increases and feeling like after you've been a customer for so many years, you haven't had any claims, all of these things. And then all of a sudden your rates go up exponentially. It really has a huge impact on satisfaction and, likelihood to shop and switch.
Thanks, Breanne. Jim, why don't we get to the how part of this question? How can carriers price more accurately? And I think we want to specifically focus on the use of vehicle information and even double clicking on that, the specific VIN data. So how can the industry price more accurately using VIN data?
Sure, Mike. Well, really, this is all part of our VIN data solutions at JD Power. And our auto data division provides VIN solutions that adequately describes a vehicle. And our insurance clients have really proven to us that more comprehensive and accurate data helps them to provide more adequate pricing, more accurate pricing of vehicles that they're insuring. And at the end of the day, it really falls down into two kind of primary categories. It's making sure that the value of the underlying asset, the value of the vehicle, is accurate. And one example that we like to talk about frequently is a Ford F-150. And then you even look at a single trim, an XLT. A fully equipped Ford F-150 XLT could sell for upwards to high $90,000, $99,000, where a lower equipped vehicle could sell at maybe $48,000, below $50,000. So you're talking about almost a double in the value of those assets. So knowing the price is really key. And we have found and heard from our clients that the worst place to find out that you're not adequately pricing your policies is at the time of a total loss. And that's when you have to cut a check for that vehicle and find out that your assumptions were wrong and you haven't been collecting enough premium. And ultimately, you're going to increase your loss ratios. And, the goal is to keep your ratios low. So, paying out more than you're collecting is going to force them to go up. And then the other area is really the safety of the vehicle. So you've got the value of the vehicle and you've got the safety of the vehicles. And we look at things with all, vehicles today, more and more new vehicles have more advanced driver assistance packages, more ADAS features. And we look at things like maybe automatic emergency braking. And when you look at that, you say, oh, well, that's got to decrease risk because it's going to automatically stop the vehicle if there's an accident. It's going to lessen the damage if there is ultimately an accident. And then you look at things like adaptive cruise control, which might keep a vehicle in a safe distance from the driver on the side or ahead or behind. But it may ultimately lead to more distracted driving. So having the data one way or the other ultimately will help our carriers price their policies accurately.
Thanks, Jim. So we've talked about why price accuracy is important. We've talked about how to do it using VIN data, vehicle data. But just to be realistic here, when we talk about changing a process for the insurance industry, something as important as pricing, it's just going to take a while, right? It can take a long time. to kind of prove out that this is a better way of doing things and can improve profitability and that kind of thing. What ideas do we have to help carriers kind of accelerate this better mousetrap, if you will, in terms of adoption? What are some things that carriers can do to kind of test this and prove out the business case sooner rather than later?
I could take that, Mike. So as we were discussing earlier, carriers want to make sure that they're maintaining their high value customers. So that may be an analysis of whether you're overpricing or underpricing for those particular customers. And particularly when we look at the time of renewal, has their car depreciated or has it maintained its value more than their models, the actuarial models indicate? For lower value customers, as we've mentioned, or higher risk customers, yes, carriers want to keep them, but at the right cost. So the kind of the good thing about our VIN data is the fact that it can be automated into a process. If you provide us with just a VIN, the 17-digit VIN, within milliseconds, we can return all of the build data on that vehicle. What was the cost of the vehicle, the MSRP? How is it equipped with all the features and the safety features? And frequently, we even look at carriers, a portion of their book, maybe it's a region or some type of a sample, and we can very quickly turn around results that they can validate and look for some impact in their industry.
So what is the size of the opportunity here in terms of the economic impact to the carriers to make this investment and improve price accuracy? What's the business case? What's the ROI that carriers can expect from adopting this new approach to pricing?
So if they can lower their loss ratios, and ultimately they're going to improve their long-term profitability. And when you look at it from a pricing perspective, if you're not adequately pricing a policy and it's maybe you're underpricing by a couple $100 every 6 months, and the cost of the data is literally less than $1. So you're spending maybe less than $1 to capture hundreds of dollars per policy, and you multiply that times millions of policies and price the policies adequately, the return is very significant.
Terrific. Steve, anything to add?
Yeah, I'd add into that. So we're talking about kind of on the back end, the claims costs and such. Accurate pricing helps on the front end too. So with business development. So if we're more accurately priced at an insurance company, we're more likely to win the risks that we're truly trying to win. We all know that not every insurer has the same risk appetite and is trying to find the same type of customer. So anything you can do, including the data that Jim's talking about today, in terms of improving your intelligence around the auto physical damage losses that you will incur for the policies you're selling, you can more precisely target the type of customer you want to win, be more accurately priced with them so that when you're winning business that will be profitable. When you're not winning that customer, it's because somebody else is underpricing and you may not want to take on that underpriced risk, right? So it helps with the confidence on the front end too of we're winning the right customers and we're winning them at the right price.
Breanne, anything to add?
Yeah, I mean, I would just echo basically what Steve just discussed. If you can get customers in at the right price, it's just going to make the servicing aspect easier because you're not going to be up against a wall when it comes to raising rates. So the more that we can, customers can kind of come in at the right price and there's basically enough reserves and everything to cover claims, which is also going to, help with the servicing aspect too. It's going to help make the whole experience better overall.
Okay, thanks. That was a great conversation. Jim, Stephen, Breanne, thanks for joining us today. And we want to thank our listeners as well. And we'll see you next time.